Great. In this section, we are going to look at for financial instruments, a summary about it, a quick review of financial instruments. To get a full picture, kindly use the previous lecture videos to get a full picture. We are advancing the video, like making little updates, and then summarizing the entire section. Now, when you talk about financial instruments, it's a very topical issue in financial reporting that accounting students should take note of that. Financial instruments. So now it's a topic that have 4 standards currently governing financial instruments, starting from IAS 32. It talks about presentation of financial instrument, just presentation, how to present it. We have IAS 39, just talks about recognition and measurement of financial instruments. Recognition and what? Measurement. Again, we also have IFRS 7. It talks about disclosure. And we also have IFRS 9. That one talks about financial instruments. Wow. Okay, so financial instruments, the leading standard on it is the IFRS 9. However, IFRS 9 is not it's not fully published, fully completed. The IFRS 9 combine IAS 32 and 39 together. So as soon as they are fully finished or fully complete or fully published, it means that these 32, 39 need to be cancelled. Then left with only IFRS 9 and 7. You know, 32 talks about just the presentation. 39 talks about recognition and presentation. And 9 talks about combining these two together. So that is the job of these standards. So I can assure you that for examination purposes, it is a 39 that is on top, and then the 9. So if you want to read more, 39 and 9, you are free to go. Whatever 32 and 39 is saying has been summarized in IFRS 9. That is the section. Okay. So basically, that is it. Now let's quickly provide a summary of financial instruments, so that when you are using the previous lecture, you know where you move from, where to click it. So can you check the video description section to probably pick up the previous lectures on financial instruments? Okay. Let's do something in here. Now that we know the standard that governs financial instrument, let's start. What is financial instrument? F5. Financial instrument. Now, financial instrument basically talks about contracts or relationship or transactions. Financial instrument basically talks about contracts, transactions, relationships. That gives a financial asset to one party and financial liability or financial equity to the other party. So financial assets, financial instrument simple means a contract or transaction or a relationship Yes. You have a relationship with your customers. You have a relationship with your bankers. You have a relationship with your what? That of your investors. Good. There's a contract or transaction or relationship that gives rise. That gives rise to a financial asset, FA. Financial asset to one party and financial liability or financial equity to the other party. That is all. So in a single transaction, it could be an asset to the other party or a liability to the other or financial equity. Basically, that's the definition for financial instrument. So that transaction should give rise asset to someone. For instance, if you acquire shares, if you buy shares, the purchaser is an asset to you because you are making an investment. It's a financial asset to you. And the company that you bought the shares from is a financial equity. That is all. So that's a typical example of what? Financial instrument. Perfect. For instance, you secured a loan from a company or a bank. Bank loans. Now, this loan that you secured from the bank, to you, it's a financial liability. What about the bank? It's a financial asset because they are making investments. So that's a financial instrument, basically. Pick it from there. That financial instruments are sections or transactions that give rise to financial assets, financial liability, or equity. Good. Now let's look at this. What are the types of financial instruments? Basically, we will have 3 types of financial instruments. We should know how we should recognize them or record them. That is a presentation. So types of financial instruments, basically 1, 2, 3. But then 2 and 3 are almost one, they are together. We have financial assets, so we should know how we can record financial assets. Financial liability, financial equity. So these are the types of what? Financial instruments. So take notes, and we should look at how best we going to record them. Most often, this is the topical issue, so that's what I'll do today. And what I will go through today. I'll only talk about financial liability today, but we do have a little time. But financial asset and financial equity, kindly use the previous lecture video. It talks about it fully, everything you need to know. But don't forget to subscribe. If you have not done that, share to your friends too. Okay. Now let's see. When you talk about financial assets basically talks about right to receive cash, not a promise to receive cash. So there's a difference between promise and right. You have right to receive cash. You've entered into contract with someone and the person has to pay you. That one you have right. But if friends and promise that, oh, tomorrow I'll give you 10 cedis. The person promised you, that is not a financial asset because it's not a binding. Before financial asset will work, there must be a binding, legal binding, something that will force compulsory, something that will let you receive cash. By all means, that is the financial asset. Okay. Or you can also enter into a contract with someone and you will benefit. Exchange of assets, but you benefited. That is a financial asset. How we get it? So financial asset basically means right to receive cash. Right to receive what? Cash. And entering into transaction and a situation where you were favored or exchange transaction and you were favored, like you've been favorable. For instance, let me give you a critical. You want to swap your current device for another alternative one, but realize that you are holding, let's say, a small device like this, and now you've exchanged it for a very powerful and big device. So it tells you that you are being favored under this contract. So that means a financial what? Asset to you, basically. That is the definition. I'll go to financial liability. It's just the opposite. It's the obligation. You have obligation to pay cash. Obligatory, not a promise. Or I'll pay you intensity. No. It must be something that's binding on you. Good. Or you enter into exchange transaction, exchange assets. Bring your car, come and take the land. Bring building, come and take vehicle. At the end of the day, you are at disadvantage because you submitted a lot of items for fewer or little or less value items. So you are a bit unfavored. Now it's a financial liability to you. Good. Now, when I ask you to define financial equity, remember what we did under the conceptual framework. Financial equity, we don't have a specific definition. Just the examiner. Financial equity is nothing but asset minus all liability. That's all. So financial equity is a residual interest after deducting all liability from all assets. We are done with it. Now, go into detail. Before I start, let me finish the IAS 32 by looking at special case of preference shares and take note of that. From there, we are done with IAS 32. We now entered into what? IAS 39. And that's where we remain for some time until we are done. Okay, now let's look for one last item and quickly move on to that of financial liability or IAS 39. That talks about recognition and measurement. What I'm going to do, we'll look at it, I think, under earnings per share. But this is where it's supposed to be dealt with. We call it a special case of preference shares. When you talk about preference shares, what is the classification? What is the treatment of preference shares? Basically, preference shares. At some point in time, preference shares are liability. At some point in time, they are equity. So let's look at those changes. Okay, so in the special case of preference shares, how do you treat them? Now, look at this. This is very important. There are basically two types of preference shares, or two kinds of preference shares. We have what you call redeemable preference shares. So redeemable preference shares, and what? Irredeemable. We also have irredeemable preference shares. Now, obviously, redeemable preference shares, it's a liability. When we enter here, it's a liability. So classify it as what? Liability. Irredeemable is equity. Now, how do you know that this is redeemable when not stated clearly against it? Now, if you see preference shares without any demarcation, we assume that this is what? Irredeemable. Because ideally, if it is redeemable, they should tell us it must come with it. So if I write a preference shares and write, let's say 30,000 preference shares, 30,000 series like this. This is irredeemable preference shares because if it is redeemable, I'll tell you that, okay, into bracket, redeemable at 2015 or 2016, 2030 in that order. So if I write preferential with that any description, please we mean or we refer to as what that irredeemable. Now let's go into deeper waters. When you pick the redeemable, there are three types of redeemable. We call it option to redeem. Who have the option to redeem? So let's write here option to redeem. Option to redeem. Who have the option to redeem? Meaning to call back the preferences. Who have the option? So there are two people that have the option. The option must lie in one person's hands. So we have what you call the holder and the issuer. So holder and what? The issuer. Now, if the holder have the option to redeem, then it's a liability. That is like a what? A liability. If the issuer have the option to redeem, it's an equity. Wow. This one is an extreme. These sections are extreme. Good. So if the holder have the power to redeem, then it's a liability. It's not an equity. But if the issuer, the company that issued the preferences, they have the power to redeem, call back those preferences. In fact, they will not call it. That's why we are saying this. It is equity. They will call it when things are very okay, things are smooth with them. So it's what equity. Take note that dividend paid on this will also have a different treatment. For instance, all dividend paid over here moves to a finance cost. Dividend paid on redeemable preferences moves to finance cost. However, if the option to redeem is in the hands of the issuer, that is the issuing company or the issuing house, then the dividend paid moves to equity, changes in equity. That one goes to equity. Take note, the dividend paid moves to equity. Okay. Okay. If the option to redeem is in the hands of the holder, then it's a liability. Dividend paid is what? Finance cost. How to get it? Here, dividend paid is what? Dividend paid goes to equity. Changes in equity. That is all. So kindly take note of this. And we did it for IAS 33, earnings per share, where we said that the earnings per share is equal to the profit after tax less irredeemable preference dividend, because that one has not subtracted yet from the profits. That is it. So take note of this, very important. Now let's go to financial liability, and then I will just explain the gist of it, and then we end it there. Meet again for questions. Sorry. Kindly use the previous lecture to clear everything from presentation up to recognition, fully covered in the previous lecture. Can we use that one for a full picture? This is a summary point. Yes, I'm going to summarize financial liability. So use the previous lecture to go through financial assets, how to treat it. So I do have a terrible questions. I'll check those questions in. Yes, then we look at them. Okay, financial liability. How do we measure financial liability? Financial liability. Financial liability. Now, third examiner, that financial liability. Oh, in fact, let me stop it down. All financial liabilities are measured at amortized cost, except otherwise stated. All financial liabilities are measured or recognized at amortized cost. So they are measured at what? Amortized cost. Amortized cost. So basically that. Okay. Now what is the amortized cost that we are talking about? So you go stage by stage. Go stage by stage. So at this stage, all what you are looking for is this financial liability. We have secured a loan or a debt instrument from a holder. We are the issuer. We've issued bonds. They've acquired it. The purchaser have it. Now we owe them. Yes, they've given us their money. So how do we account for it in our book? We are saying it's amortized cost. Amortized cost simply means most of the liabilities are held to maturity. They are held to maturity. Meaning that it have a fixed period. Until the period is over, we are not paying the debt. Have a fixed period. Fixed period. So the loan is going for 5 years. So after the 5th year, before we go and hand over the principal. Meanwhile, every year we pay interest on this loan. Every year you service the interest, paying the interest. So let's assume that we come for 10,000 cedis from a bank, paying interest at the rate of what? Interest is 12% for 4 years. So it means that amortized costs will come to that. It means that we are going to hold this one till it matures. Meaning year 1, we will pay the interest. Year 2, year 3, up to the year 4. In the final year, we will pay the interest plus the principal amount at the final year. That is the meaning of what? Held to maturity. Perfectly. Now, I wish I could have probably gone through financial assets to build it from there, because whatever we do under the financial assets is just a top up in the financial liability. So just the financial liability just top up a little. But since you go through, you'll be fine. Let's do something here. Amortized cost means that we should quantify the liability using the effective interest rate. Consider the effective interest rate. So let's assume here so what happened is this. Let's assume we have a debt. So now we go to like this. Company A issued 5% loan note. 5% loan note. 5% loan note. 5% loan note. With a par value of 10 million for 9.4 million cedis. Full stop. the transaction cost happen to be, let's say, transaction cost happen to be, let's say, 60 days. Transaction cost is equal to 0.2 million. Okay, full stop. The loan will be redeemed. Redeemed in 4 years' time. Which has an effective rate of, let's say, 9% full stop required. Account for the above in the books. Okay, so basically, when we are dealing with financial liability, we need to get the proceeds. Third examiner, first thing you have to look out for is the proceeds. How much actually you receive. See, you can go to the bank that, Mr. Bank Manager, I need a loan. I need 10,000 to this. But by the time you realize the actual money that will come in your hand will be like 8,000. They've deducted a lot of fees. Oh, these charges, this administrative charge. By the time you realize the money that reach your hand is not even up to what you requested for. I'll be getting. So that's why we have to cover the proceeds. How much actually you receive from your hand, like you received from the people. So I'll generate a formula for calculating the proceeds. Only 3 steps. Number 1, bring the par value, subtract discount, subtract transaction cost. That is all. So par value, less discount, and less transaction cost. Discount means the money was discounted, so you end up receiving little. 2, transaction cost. It could be administrative charges, broker's fee, processing fee. Before the stock market process your bonds or your loan notes for you, you need to pay a fee or a commission to them. So all these commissions should be net off against what you are receiving. So at the end of the day, if the value is supposed to be 10 million, and then you have to pay the brokers, those that deal with the loan notes for you, those that made a sale for you, you end up receiving a little. So third examiner that. But if I can't copy, let me take it off. I'll summarize it here for you. I'll summarize the question at one side, if I could remember the figures. So par value or nominal value of the loan. Nominal value of the loan is 10 million. Purchase value. Purchase value is 9.4. That means there's a discount. Discount of 0.6. Okay. That is a discount to. There's transaction cost, right? Transaction cost of 0.2 million. Maturity dates, how many? 4 years of maturity. 4 years time. Then nominal rate, the nominal rate of interest. Nominal rate is what? 5%. We have what we call effective rate of interest. It's 9%. This is the question. First thing you have to do is tell the examiner, I need the proceeds, how much we actually receive from the debt. So first, you can start from the purchase value. Even though I'll give it, let me give the general formula first. You start from the nominal value or the par value. So much less discount. So much less transaction cost. That is all. This gives you the proceeds, how much you actually receive from it. So that is all. Now let's see how best we can generate these figures. What is the nominal value for this particular debt? Is 10 million. So that means the face value is 10 million. 10 million. Is there any discount? Discount was 4. Sorry, 0.6. Please and please again. If you let the discount from the nominal value, give what you call purchase value. This minus this is called purchase value, the actual purchase value. It was sold for this. It was apart for this. That's the actual. Okay. All of them subtract. What about the transaction cost? Transaction cost here is 0.2 million. So 0.2. Take it off. So at the end of the day, the value of the loan is what? 9.2. That's the proceeds. That's the first thing that you do. Proceeds. That is all. Then you proceed to calculate what you call movement in liability. We have a nice name. We call it amortization schedule. So let's go into that one. Movement in liability. Right after, determine the proceeds. In situations where there are no discount, if here is dash, oh, then that means the nominal value is the same as what? The proceeds. So that one, there's no issue. You requested for 10,000, they give you the 10,000, no charges, nothing, no discount, they didn't discount it, they didn't deduct anything. So at the end of the day, whatever you receive is the same as whatever you requested. That scenario could also happen. So take note of that. Okay, so let's go and do the last aspect and then we move on. Okay. Now, we have what you call movement in what? Liability. Movement in liability. So let's perform now workings. Movement in liability. That one, we have only 4 columns. The year, you record your year, you record the balance brought down, you record the effective rate, the nominal rate, and the closing balance. That's the liability at the end. Okay. Let's work in thousands of zeros, like thousands. You are working in thousands. Now, what will be the liability at the start of the year? Effectively, in fact, effectively, you are owing them the proceeds. How much they gave you at the start of the year. So year 1, year 2, year 3, year 4. That means you owe them 9,200. Now, what is the effective interest rate? 9%. Now, the effective interest rate is the actual rate. Let me explain this to you. Sometimes banks will tell you that, okay, our interest rate is 5%. By natural sense, by the time you realize finishing paying everything loan, realize that you pay more than the 5% they've stated it there. But if you do the calculation too, you don't see where the extra money is coming from. So that tells you that this 5% was quoted to attract you. In actual fact, putting all conditions, everything, to consideration, you actually pay for 9%, not the 5%. That is the effective interest rate. This one, we normally call it, if you should have gone to the market, if you should have gone to the market, that is the market rate. And that's the internal rate of return. Good. That is the rate. Now, what happened is this. The nominal rate is a face value or the quoted rate. That rate can be 0. Yes, nominal rate can be 0. Hardly for effective rate to be 0. Effective rate cannot be 0, but the nominal rate be what? 0. That is the interest-free loan. Government interest-free loan, the nominal rate is 0. Good. So that is that. Now let's see. Can we apply the 9% on the open balance? So the 9% on all the open balance. So what do you get? So 9% times 9,200. That is it. And you put down there what? The effective interest rate. Okay. So first line, what do you get? So that should give us 828. Now let's find the nominal rate. Nominal rate is 5%. And always the nominal rate is on the face value or the nominal value, 10 million. So 5% on 10 million. The nominal rate is always on the face value. So 5% on this. It's 9%. So 9% times 9,200. It should give us something like 828. Okay, we've read 3 zeros on top. We have 3 zeros on top. Okay, so let's go to the nominal rate or nominal interest rate. The nominal interest rate is 5% here. So find 5% on 10 million. That should give us 500,000. So let's record 500. Can you put it in brackets? And it will be the same for all the years. 500, right? All the years, 500. Average. The nominal rate is the same and it's fixed constant. All level. Now, what we do is this. Amortized cost. The word amortized cost is just the difference between the effective rate and the nominal rate. This is it's called amortized. So the word amortized means amortized cost means the difference between the effective rate and the nominal rate. It's called amortized cost. So this minus this, then you add it to this, or add all and subtract this figure from it. So this will give us something like 328. So that will be 9528. That will become the closing balance. Agree. This will be the closing balance. That will be the closing balance. Okay, then you push it in here up to 9528. Again, you find 9% on this figure. Then you push it through again. That's it. So you get 858. Good. Then we add 858 to this. Then we less 500 from it. What do we get? 9886. Okay, so we get something like 9886. And that becomes the open balance for the third year, 9886. Again, we find 9% of this figure and we keep in as the effective interest rate. That's 890. Again, we amortize it by taking this one from it and add back to the liability at the start. And that will give us something like So 986, let's give us something like 10,276. So 10,276, okay. 10,276. Then finally, if you get to the final year, you put it here 10,276. Normally, if it's going to be redeemed at premium, this bond or this debt, it means that they redeem it at what? Premium. So usually we will tell you the value, the premium, or the percentage, or the value. You have to work and then get that. So that's 925. You add it to and then we subtract 500 from it. 1,070, 701. So it means that that figure here must be 0, meaning that it will be redeemed at the end of the year 4. And before that place to be 0, you have to again record. So that in the final year, you get two values. The redemption value is 1,700. So before you can get 0. So in the question, this one, if I'm updating the question, I'll key in it to be redeemed at premium of 1,700. Good. Or 1,700. That's 10,700,000. That is it. That means if you work, you must get that answer. Now, when you get to the last year, we are redeeming it. So the balance should be 0. Or you can carry this balance here. If you carry this balance here, it suggests that the loan has not been redeemed. Maybe they've not redeemed it, so it's still hanging. But in actual fact, it must be 0. Actual fact must be 0. And can only be 0 if you place it as negative so that you knock off this. Now let's go to the treatment, the accounting treatment. That's the most important thing. Then that is all for financial liability. The rest is question solving. Now, when you go to a P&L, all the effective interest rate go to the P&L as finance cost. So let's see something here. So your year 1, year 2, year 3, year 4. Your finance cost. You write interest on loan notes. The year 1 interest, effective interest rate is 828. Year 2 is 858. Year 3 is 890. Year 4 is 925. Agreed. That is how your P&L will look like. Kindly post all these figures. It goes to what? P&L. All the closing balance goes to financial position. So in your balance sheet, you have what you call non-current liability, right? Loan notes, no shortcut. 1, 2, 3, and year 4. Year 1, the balance was 9,528 in thousands. So we are working in thousands. All these figures are in thousands of 0. Everything in thousands of 0. So here will be 9,528. The next one is 9,886. The next one is 10,276. The last one was 0 because it has been redeemed. We have paid back the money. We don't owe anybody again, so it's not 0. That is how the Excel look like. We are done. Basically, what left is how to probably find a price with the help of if they don't give it to you. And then second, you have to look at what you call compound instrument. And then I have some few terrible questions that in the next meeting we will discuss that particular one. However, this question we have to look at it carefully. The compound instrument. Compound instrument. So what level is a compound instrument? You can move straight to a YouTube channel and then locate the I think type personal contract and look for that of financial instruments. If you go to the financial instrument, there are two sections there. This one, that's what talks about the this is what talks about the starting point, the financial instrument, the part one, and all of them. Then can you go to a compound financial instrument? That's the part two. If you're able to go through this, I think you'll be fine. If you're able to go through this, so talk about the compound instrument. So now pick it from this up to this. Good. Pick it from this up to this, and then probably you are done. This is just 38 minutes. So within 38 minutes, you should be able to finish the last and then part of the financial instrument. One level of probably series of question solving, and then those questions should be ready, and we will demarcate a time for you to probably solve the question. So that's basically, and kindly subscribe to our that, and then use the playlist to navigate through. So if you want financial reporting, tap on financial reporting. All financial reporting videos will probably be available for you. All the financial reporting videos will be available for you. So financial reporting videos, all of them are in here. All of them are in here. Also, on that note, we'll probably end here and continue next meeting. Can you solve more questions? In the lecture material, I have a lot of questions in there. Some of them have been solved, some of them to no solution. You have to provide it. You can go through that. If there's any question, you can let me know. If you don't have the material to let me know. I'll share the material. Today, I'm not probably project most of the materials, but I'll make them available. Okay, so thank you very much for coming. Have a nice evening. If you have any question, you can ask the questions in the comment section. I'll pick it up and then work on that for you.